Welcome back. We are now in segment 8.6, and in this segment we will be discussing about current ratio, right? If you recall, in an earlier segment we had discussed about net working capital. So if you are comfortable with net working capital, you should not be finding any problem in with current ratio, because both of them are really the same, right? One is a number. We are speaking of a absolute quantitative value, because NWC is nothing but current assets minus current liability. Current ratio is the same quantities, current assets by current liabilities, right? You find a ratio. What we are basically tracking is the margin, right? How much portion of the current assets are being financed by the long-term sources. So if you're comfortable with NWC, you'll not be finding any problem with this segment. If not, please go back to the segment on NWC and refresh your concepts. Okay. So suppose so to understand why we require current ratio when we already have NWC, right? So why are we calculating current ratio when you already know NWC? We know what NWC is. We can calculate, say NWC is say 120 lakhs for a particular company. So we know NWC. So why are we again calculating current ratio when technically we are actually taking the same two parameters which were considered for NWC. NWC is current assets minus current liabilities. We have already calculated. You got 120 lakhs. Why are we again calculating a different metric called current ratio, taking these two same inputs? Okay. So what does current ratio tell us which NWC doesn't tell us? So to understand that, let's take this example, right? Say for example, in your bank there are two branches, right? One is a small branch. It is having a deposit figure of 10 lakhs, 10 crores, right? 10 crores on the as on the previous year. So this year it has increased to 15 crores. Okay. And there is another branch, a larger branch, whose deposits has increased from 500 to 510 crores. So if you see the increase in absolute rupee terms, this increase was 5 crores plus, right? This is plus 10 crores. So you might be tempted to say the larger branch has performed well, right? If you look at the absolute values, because the larger branch has increased, right? Increased its deposits base by 10 crores, whereas the smaller branch increased by only 5 crores. But that would be a very misleading picture, right? You all agree that if it comes to promotion, you need to reward this particular branch, smaller branch, because he has shown an increase of 50% compared to the last year. You see, the increase is only 5 crores, agreed, but that 5 crores is coming on a base of just 10 crores. So he has shown a growth of 50%, whereas the larger branch has shown a growth of 10 crores. The amount might be large, but compared to the base of 500, it is only 2%. Right? This is how you basically give promotions, right? So we are not really concerned about the absolute figures. We are seeing here the percentage growth, right, compared to the previous year, right? So you need to understand that absolute numbers can be very misleading, as we have seen in this example, right? Absolute numbers can be misleading, and it's very difficult to compare two branches or two companies or any two. It's not just for this particular branches, but any two values. When you look at the absolute values, it's going to be very tricky. So the solution is always use percentages or ratios, right? So yes, NWC told us what is the absolute value in the rupees term is telling us what is the, so in rupee term it's going to tell us what is the difference between current assets and current liabilities. This is correct, right? That is okay. But and we have already seen that the NWC represents the portion of current assets that is financed by the long-term sources. So everything is fine. But then again we have the same problem, right? Is a company with NWC 25 lakhs better or NWC 10 lakhs better? We cannot answer. This is where things will be tricky. Just as in the previous example of two branches, if I were to ask you which is a better NWC, 25 lakhs or 10 lakhs, see these two examples. Company A is having NWC of 25 lakhs. Company B is having NWC of 10 lakhs, right? So if I were to ask you which is a better company, you might be tempted to say company A because it has a higher NWC. It's in a better financial position as far as liquidity is concerned, right? We are not concerned about the remaining parameters at this juncture, but as far as the liquidity position is concerned, you might be tempted to say company A is in a stronger position. But we said that NWC, what does NWC mean? The portion of the current assets that is financed by the long-term sources. So out of the total current assets of 1,000, 25 is being met from the long-term sources. So that is what NWC is, right? So 25 by 1,000, that is 2.5% of the total current assets. Just 2.5% of the total current assets are being financed by long-term sources. Whereas in the second example, right, 10 by 30, 33% of the current assets are financed by long-term sources. So if you look at it, it looks like company B is in a better position, right? Because we told that, we already discussed that. We always want a situation where a larger portion of current assets are financed from long-term sources. Why? Because there will be less pressure on the immediate short term. If this figure is low, it means there is a compulsion to pay the current liabilities in the near future. Whereas if this figure is high, we are saying we are saying there is less pressure to pay the current liabilities in the near future. This is a concept which we already discussed. So please refer back to the segment on NWC if you're not comfortable. Essentially, what we're saying is we want this figure to be as high as possible. So higher this figure, say for example, it is 90% and 10%. If 90% of your current assets are financed by long-term sources, right? Long-term funds in the sense that a repayment is not, there is no urgency to repay them right now or in the next 1 year. You have time, you have comfort, right? You have buffer. You are in a very reasonably good position to postpone these payments because you have time to repay them. Only 10% are short term, so you need to repay within 1 year, right? So this is all right. This is a very small amount, right? But if you have the other scenario where 10%, only 10% of your funds, of your current assets are financed by long-term sources and 90% are financed by short-term sources, these sources are to be repaid within 1 year. So there will be more pressure, more liquidity pressure to repay these short-term liabilities. That is essentially the concept of NWC. So coming back to our discussion, in this example, it is very difficult to say just by seeing the absolute number of absolute quantity 25, 10. We cannot say which is a better company. We cannot compare. We cannot say because NWC of company A is higher, it is in a better position as far as liquidity position is concerned. We cannot say that because we just now calculated that in the first company only 2.5% of the total current assets are financed by long-term funds, whereas in the second case the figure is 1/3, 33%. So actually company B is in a better position, right? So to get around this problem, we calculate current ratio. Current ratio will be bringing all companies to a common platform, right? It will be reducing all companies to a common platform. Now we can compare. We cannot compare based on NWC. This is the reason why. Absolute figures are going to be misleading. For a large company, the NWC will obviously be higher, right? For a company dealing in crores, NWC will be higher. A company dealing in lakhs will be smaller. But just because the absolute value is lower, you cannot say the company B is in a poor position. You cannot say that. So to get around that problem, to enable comparison between multiple companies, we choose another metric known as current ratio. We'll take the same figures. We'll take the same two terms, current assets and current liabilities, which we calculated NWC, through which we calculated NWC. But what we're going to do, we are going to take the ratio this time. So what happens by taking the ratio is this will bring all companies to a common platform. Now we can compare different companies. Let us see how. Technically, both of them are same. NWC is current assets minus current liabilities, whereas current ratio is current assets by current liabilities. Both are tracking the same two terms. It's just the difference in the mathematical treatment. This is a difference. This is a ratio, right? So because of the similarity between NWC and current ratio, this will be always holding good. Okay. So if NWC is 0, current ratio will be 1, right? Obviously, say current assets are 90, current liabilities are 90. So what is NWC? Current assets minus current liability, 90 minus 90 is 0. What is current ratio? Current assets by current liability, 90 by 90, this is 1. This is what I'm saying. Current ratio, if it is 1, it means NWC is 0. And similarly, you can verify that if current ratio is greater than 1, NWC will be positive. If current ratio is less than 1, you want NWC to be negative, right? So you always want a situation. You always want the current ratio to be 1, that is NWC to be positive. Not just positive, not just any other figure like 1.05 or 1.1. You want it to be greater than that minimum NWC. This we already calculated, right? Minimum NWC is 25% of current assets for large borrowers. Or in terms of current ratio, this is 1.33. So it's not just sufficient if NWC is positive or current ratio is greater than 1. It should be greater than 1.33 for large companies, right? This we already seen. So we can take an example here. In the first example, you can say current assets is 100, liability is 80. So NWC is 100 minus 80, 20. If you calculate the ratio, it is 100 by 80, 1.25. So here you can see current ratio is greater than 1 here. And that's why NWC is positive. In the second example, current ratio is less than 1, which means NWC is negative, right? In the third case, current ratio is 1, NWC is 0, right? You can verify this. So a lot of bankers are very confused with this odd term 1.33. So when we said that current ratio, banks usually have a norm that current ratio should be greater than 1.33 for large borrowers. So with the very confused, I mean, from where the hell this 1.33 has come? Why such an odd figure, right? Why can't we have a figure like 1.25 or 1.5? Why don't banks stipulate? A current ratio should be greater than 1.25 or 1.5? Such a nice rounded figure, right? Why this odd amount? From where did this 1.33 come from? So it so happens that there is a very nice logic behind this, right? This is not an odd figure. In fact, this is a round figure. The round figure is, if you know, this is 25%. Generally bankers want, I mean generally on an average, if you see across all sectors, across all borrowers, you know, basically bankers look at a margin of 25%. Again, this varies, right? For vehicle loans, maybe for housing loans it will be lower, right? In real estate it will be higher, right? 40%, 50%, but on an average 25% margin is something which bankers look for. So this 1.33 flows from this 25%. So say for example, your current assets totally put together are 100, right? Your current assets totally are put together 100. In an earlier segment, we said that current assets will be financed by three parties, right? By the borrower, their own margin, bank will be financing, and creditors will be financing. This we already discussed, okay? For a simplistic purpose, there will be other current liabilities also, but for the moment, let us assume these are the three major parties who are financing the current assets. So out of this, which is long term and which is short term, margin is always long term. This is the borrower's margin, and the remaining two are short term. Bank, this is the CC limit, and the creditors are short term. So these two are short term, this is long term. So what I'm saying is bankers want this margin to be 25%. So if the current asset is 100, they want the margin to be 25, and the remaining 75, these two will be taking up the short term parties, that is the bank and creditors. So now if you calculate current ratio is current assets by current liabilities. Now you will get current assets is total 100. What is the current liabilities? These two, right? 75. So this is 4 by 3. This is 1.33, right? So this is 1.33. So this 1.33 is not a very odd amount. Actually, this got a very nice logic. It is based on the 25% margin from the borrowers, and that's why you end up having current ratio of 1.33. So the next time somebody asks you why current ratio is stipulated by banks to be 1.33, this is the logic, because you want the borrower's margin to be 25. That is the reason why you end up with 1.33. Say for example, this is for a large borrowers, right? This is for large borrowers. So large borrowers, you wanted 25% of current assets. So banks usually have a lower margin for small borrowers, right? Say for example, they'll have some 13% of current assets for small borrowers. Small borrowers, maybe let us have a stipulation less than 5 crores. All borrowers who are availing limits, working capital limit less than 5 crores are small borrowers. Let us assume this bank has such a policy. So, and he said that the NWC, the minimum NWC should be 30% of current assets. Here this is for large borrowers. Minimum NWC is 25% of current assets for large borrowers. But this bank has said for small borrowers it is sufficient if we have 13% of current assets. So can you now calculate what is the minimum current ratio? Right, take a moment to calculate minimum current ratio. Same logic, right? So please pause the video and try to answer this. So hope you have answered that. So the logic is very simple, right? So again, current assets total 100. So this will be financed by three parties. We said what are the three parties? The borrower, the borrower's margin, right? The bank will be financing and the creditors will be financing. Who are long term? Only margin is the long term. These two are short term. So now what bank is saying is the margin should be 13. If this is 100, you want 13 from the borrower, 13%. Borrower in the sense that long term sources, okay? Not just borrower, NWC, right? So the remaining 87 will be flowing in from the short term parties, that's the bank and creditors. So now you can calculate. Now you can very well calculate current ratio. Current ratio is current assets by current liabilities. Total current assets 100. Current liabilities 87. You do the math, you will get around 1.15. So this is another one common ratio. So you see this in practice, right? Banks will be saying for large borrowers current ratio should be minimum 1.33. For small borrowers current ratio should be minimum 1.15. So this is how it is derived. Okay. So like this you can calculate for any combination, right? So please be clear on the concept. Okay. So this slide is just summarizes what we just discussed, right? Say the current assets are 100. This current assets will be financed by three parties. Okay. So creditors, bank finance, and borrower's margin, or we'll start with borrower's margin as a simplistic case. What we're actually saying is the long-term funds, all long-term funds. Okay. So these two are current liabilities, and this is the long-term liability. So out of this current assets 100, you want this to be 25, right? 25% of 100. So the remaining will be 75. These two put together. So current ratio is current assets by current liabilities. So current assets is 100 by current liabilities 75, 1.33. So essentially what we are saying is out of the total current assets, right? Out of the total current assets, long-term funds are financing 25%, and 75% is being financed by the short-term sources, right? So this is nothing but NWC, right? What is this NWC, right? This we already discussed. NWC is the portion of current assets. What is 25? 25% of the current assets are being financed by long-term funds. So what is NWC? the portion of current assets that is financed from the long-term sources is NWC, right? So this is for a small borrower. Maybe your bank might have a different benchmark ratio. Usually it is 1.15 for small borrowers, where we stipulate 30% of the current assets. Okay. So if it is different for your bank, say for example for small borrowers, if your bank has stipulated say 15% or 20%, you can do this same calculation. Okay. So what if it is 15%? What will be? It will be 100 by 85. Whatever is the ratio. If it is 20, 100 by 80. Right. You can do the calculation. So let us try to calculate what is the minimum current ratio in case of turnover method. So please recall, this is the table which we use for turnover method. Turnover method, please refer back to the segment where we discussed turnover method, where we said if the projected turnover is 100, banks will be sanctioning 20% of the turnover as the CC limit. So 20 lakhs will be the limit. So total requirement will be 25 lakhs. That is the current assets requirement will be 25 lakhs. Out of this, bank will be sanctioning 20. The borrower will be bringing his margin. The NWC long-term funds will be 5. So from this, if you want to calculate a current ratio, it is current assets by current liabilities. Okay. So what is current assets total? Here we are saying 25. Current liability is 20, right? 1.25. So in case of companies, in case of proposals where we follow the turnover method, minimum NWC should be 1.25. See, we do have a separate chapter on ratio analysis, which we'll be discussing a couple of chapters later. Right, I think in chapter 10. But most of these textbooks, most of the academic textbooks discuss current ratio as part of ratio analysis. So in that chapter, they'll be discussing current ratio, right? But the reason why I discussed this in this chapter is NWC is very relevant. NWC and current ratio are most relevant to working capital. They all go hand in hand. Okay, so that is why it was included here. We won't be discussing current ratio again in ratio analysis, right? This is the place where we discuss current ratio. And for a banker, current ratio is a very critical parameter. In fact, current ratio and TOL by TNW are two ratios which as a banker you will always be tracking. Any proposal, these are two ratios which you'll mostly be tracking. There are other parameters also, right? You won't be sanctioning limits based on these two ratios alone, but these are two very critical parameters which you will be tracking. You will be tracking as a banker. So you should be very thorough with the concept of current ratio. Okay. So NWC and current ratio. Right, you just cannot escape. If you're an advanced officer, you just cannot escape from these two concepts. They'll be chasing you throughout your career. Better be comfortable. And again, this is the concept which might not be readily apparent to you. It might take some time to sink in. Right, as you do proposals, you'll be becoming more comfortable. So as you're watching this video, if the concept of NWC and current ratio is not very clear, it's all right. Right? Please come back to this video a couple of weeks later. Right? And as you do your proposals in your career, you'll be having a better grasp of the concept of NWC. As I told you earlier, NWC is actually a tricky concept. Okay, even many senior bankers are not very comfortable with this concept of NWC. In fact, there are people whom it has taken years to grasp the concept of NWC. So it will take time, right? So don't be too worried if you're not comfortable with it, right? So just go on, just visit this video. Say once in a month or so, you'll be definitely there'll be some incremental learning happening, right? So with this, we come to the end of the segment. In the next segment, we'll be discussing about WCTL, okay, working capital term loan, right? See you then.